Forget the spot price for a moment. The most important number in silver right now isn't $30, it's 35%. In 2024, the cost to borrow physical silver in the London markets spiked to over 30%, a level rarely seen in modern history. While that was happening, available inventory on the COMEX dropped by 25% from its peak. This isn't a theory. I'm about to show you the official 2024 data that proves the silver squeeze is real. To understand how we reach this critical juncture, we need to look at three specific market forces. The first force is the most fundamental yet often the most overlooked: the structural supply collapse. Let's look at the hard numbers. According to the World Silver Survey 2025 data released by the Silver Institute, we are witnessing a persistent structural deficit. This isn't a one-year anomaly caused by a strike or a temporary mine shutdown. This is the 5th year in a row that the world has consumed significantly more silver than it has been able to produce. Let's break down the 2024 balance sheet to understand the magnitude of this GAP. In 2024, global demand for silver reached 1.16 billion ounces. That is the total amount of metal required by industry, investors, jewelers, and silverware manufacturers. On the other side of the ledger, total supply, which includes all mining output from every jurisdiction in the world plus all recycled silver scrap, only reached approximately 1.06 billion ounces. When you do the basic math, looking at what the world needed versus what the world produced, you are left with a market deficit of approximately 100 million ounces for 2024 alone. Now, 100 million ounces might sound like just an abstract statistic, so let's contextualize it. That deficit represents nearly 10% of the entire global supply. Imagine a grocery store that sells 10% more milk than it receives from farmers every single day. Eventually, the shelves go empty. In the silver market, this shelf space is the above-ground stockpiles, and they are being drawn down at an alarming rate. Crucially, this data from the Silver Institute highlights a trend that is getting worse, not better. If we zoom out and look at the cumulative data from 2021 through the projected figures for 2025, the total deficit is projected to be nearly 820 million ounces. That is almost an entire year's worth of mining production that has vanished from global inventories in just a 5-year window. The reason this matters to you as an investor or observer is the structural nature of this problem. Mining supply is incredibly inelastic. You cannot simply flip a switch and produce more silver. It takes upwards of 10 years to permit, construct, and ramp up a new major mine. Meanwhile, existing grades are falling. We are digging up more earth to get less metal. So when we see a 100 million ounce deficit in 2024, followed by similar projections for 2025, it tells us that the supply side is broken. It cannot keep up. The geological reality is colliding with economic necessity. So that's the supply side. We have a bucket with a hole in the bottom, losing 100 million ounces a year. Now we need to look at what is pouring into that bucket, or rather, what is trying to draw from it. This brings us to the second, and perhaps even more powerful force: unstoppable industrial demand. According to the Silver Institute, industrial demand set a new record in 2024, hitting 680.5 million ounces. This is a staggering figure. It means that industry now consumes nearly 60% of every ounce of silver supplied to the market. But the headline number hides the real story, which is the specific engine driving this growth: solar photovoltaics. In 2024, the solar industry alone consumed 198 million ounces of silver. To put that in perspective, the solar industry utilized more silver than every coin and bar investor in the world combined, which totaled about 190.9 million ounces. Think about that. The demand for green energy panels is now a larger force in the silver market than the entire investment community. But these are just big numbers on a spreadsheet. To really understand why this demand is dangerous for the supply balance, we need to make this real. We need to understand the concept of inelastic demand through the eyes of someone on the front lines. Meet Michael. Michael is 45 years old and works as a solar panel R&D engineer in the United States. He earns a solid salary of $120,000 a year, working in the highly competitive green energy sector. His job is to design the next generation of solar panels. He isn't worried about the price of silver eagles or stacking coins. He's worried about efficiency. key. Currently, Michael is leading a critical project to mass produce a new type of solar cell called TOPC-on. These cells are more efficient than the older PERC models, meaning they turn more sunlight into electricity. But there is a catch. The engineering requirements for these new TOPCon cells demand significantly more conductivity. Specifically, his new design requires 50% more silver paste per unit than the old models. Here is where the situation gets tense. Michael's company has production quotas to meet. They have contracts with utility companies and residential installers. Last week, the procurement department flagged a major risk: silver availability. They cited the recent spike in lease rates, which we will discuss in a moment, as a sign of trouble. But here is the key takeaway. Does Michael's company stop buying silver if the price goes from $30 to $50? No. They cannot stop. Silver is a tiny fraction of the total cost of a solar panel, perhaps 5 to 10%, but it is absolutely essential for the panel to function. Without silver, they have no product. Without the product, they have no revenue. So Michael's company must buy the silver at the market price, whatever that price is. They are price takers. This is the definition of inelastic demand. This scenario demonstrates that for industries like solar, silver is not application. It is an industrial necessity. Unlike an investor who might wait for a dip to buy a coin, industrial buyers like Michael's company are draining the physical market every single day, regardless of the price. Action. And this isn't just about solar. When we look at the EV sector, electric vehicles use 2 to 3 times more silver than traditional gasoline cars for their electronics and battery management systems. This cements a rising demand floor that isn't going away. So we have a structural supply deficit of 100 million ounces. We have record industrial demand of 680 million ounces, driven by inelastic buyers who must have the metal. We've seen the supply deficit and the demand surge, but where does this pressure finally show up? I'm about to show you 2 charts the paper market hoped you'd never see. This brings us to force number 3. The paper illusion shatters. For decades, critics have argued that the paper markets, futures contracts on the COMEX and LBMA, distort the true price of silver. They argue that billions of paper ounces trade hands without any physical metal actually moving. But eventually, the physical reality must assert itself. In 2024, we saw 2 undeniable indicators that the mask is slipping. First, let's look at the inventory drain. We need to focus specifically on registered inventory at the COMEX. In simple terms, COMEX inventories are divided into eligible, metal stored in vaults but not currently available for delivery, and registered metal that is available for immediate delivery to fulfill a futures contract. Registered inventory is the true available float of the market. Data from the CME Group shows that the pile of registered silver available for delivery has shrunk by 25% from its 2022 peak. It has been bleeding out. Why? Because as the industrial deficit grows, big buyers are standing for delivery. They are taking the metal out of the warehouses. A 25% drop in the liquidity of the world's primary futures exchange is a massive signal that the physical market is tightening. But if inventory levels are the smoke, lease rates are the fire. This is the second and perhaps most damning indicator. In the wholesale market, if you are short silver or need it for immediate industrial use, you can lease it. You borrow the metal and pay an interest rate just like borrowing cash. In a healthy market with plenty of supply, silver lease rates should be very low, typically close to 0 or just barely positive. But in 2024, something broke. According to data from FX Empire and market monitors, silver lease rates in London spiked to between 20 and 35% annually. Let's pause and think about what that means. When it costs 35% a year just to borrow the physical metal, the market is screaming that there isn't enough to go around. It means traders are desperate to get their hands on physical bars right now. It implies that cash is plentiful, but metal is scarce. You do not see 35% lease rates in a balanced market. You only see them in a shortage. These are not conspiracy theories. These are not rumors from an internet forum. These are market-based data points, lease rates and official warehouse stocks that prove the physical squeeze is affecting financial markets right now. The disconnect between the paper price and the physical reality is reaching a breaking point. To recap what we have covered today, the world is in a structural silver deficit, now 5 years running, with a 100 million ounce shortfall in 2024 alone. Inelastic industrial demand from sectors like solar is accelerating this deficit, consuming more metal than all investors combined. And finally, the physical strain is now undeniable, showing up in falling COMEX inventories and record-high lease rates of up to 35%. So what do you do with this information? Most people just stare at the spot price, waiting for it to move. But professional investors watch the data that moves the price before it moves. I want you to have the same advantage. Here is your immediate action plan. The watch list. Instead of just watching the price ticker, monitor these 3 metrics yourself. Number 1, COMEX registered inventories. Go to the CME Group website. Is the number continuing to fall? If registered stocks keep dropping, the squeeze is tightening. Number 2, silver lease rates. Check sources like the LBMA or data aggregators. Are they staying elevated or spiking again? Anything above 5% is abnormal. Anything above 20% is a crisis signal. Number 3, the Silver Institute's annual report. Watch for their official 2025 deficit projection. If they forecast a 6th year of deficit, the structural thesis is confirmed. This watch list gives you the tools to track the physical market like an industry professional. You don't need to guess, you just need to watch the flow of metal. If this data-driven approach is valuable to you, subscribe for more analysis like this. I will be tracking these numbers all year, so you don't have to. And one more request. Share this video with one other person who is tired of hearing opinions and wants to see the data. The math doesn't lie, and right now, the math says silver is running out. This content is for informational purposes only and is not financial advice. All investment decisions should be made with a qualified professional. The data presented is based on reports from the Silver Institute, CME Group, and market sources available as of late 2024.